Hey guys, Davis here. So welcome to another video. So in this video, I want to talk about whether you should be selling out of the money put options or in the money put options. Alright, so first of all, let's define what is out of the money and what is in the money. So out of the money is very simply when your short put strike is below the current strike price. So for example, if the current strike price right now is $79.62, so any strike price that is below this will be considered an out of the money put. Okay, and the delta is always, by the way, it's always less than 0.5, right? 0.5 is at the money, that means it's at this price down here. Anything below that will be lesser than 0.5. Now what about in the money? Now in the money, put options are basically the opposite. So they are anything that is above the current stock price of 79.62. So in this case will be 82.5, 85, and your delta is above 0.5. All right, so very simple enough. Now let's take a look at the main difference between out of the money put options and in the money put options. And the main difference is really extrinsic and intrinsic value. Now, extrinsic value, if you're not already familiar, basically it's just time value. So you can see this is the column down here. So this tells you the value of the extrinsic value for each of this strike down here. Okay, so if you take a look at the 79 strike, it says that it has an extrinsic value of 3.575. And if you would take a look at the out of the money on the other extreme, $70, it has an extrinsic value of $1.08. And on the other hand, if you would go deep in the money, all right, 90, you would see that there is very little extrinsic value. Okay, so if you notice, this is like a bell curve, right? You get the most extrinsic value right at the money, and then it starts to drop off at the both ends. So this is extrinsic value. Now intrinsic value is just the difference between the current stock price and the strike price. So let's just do a quick calculation here to see what I mean. So you can see right here that the current stock price is 79.62. And down here you can see an intrinsic value of 38 cents. So let's calculate this. So you take the strike price down here, you take 80 minus 79.62, which is the current price, and you get yourself 38 cents. As you can see, it's exactly what is stated here. So this is exactly just the intrinsic price, right? Intrinsic value is just the difference between the stock price and the strike price, which also means that this is the value that you will make if the market was to go up by the amount. So for example, if the market was to go up to $80, or sorry, from right now 79 go up to say $85, $5.38 is the money that you make, because when it moves $5, this $5.38 will become zero, because there's now no longer any intrinsic value, and that is the amount that you will make. So this is why some people want to sell in the money put option, is because you can actually make the profits of capital gains. So it's very similar to just buying a stock at 79.62, and then when it reaches 85, you just sell off the stock. If you sell off the stock, you'll be making $5.38. So this is what intrinsic value also has. So out of the money is basically 100% extrinsic value. That is just time value. It will decay the moment it ultimately will go to zero once 40 days is up. As you can see, this is the days to expiration. But if it was to make a very quick move, let's say if it's for some reason it would to rally all the way to $90, you would not make the full like $10 on this. You would only make whatever you sold down here, right? Depending on how fast it took to get to $90. Now on the other hand, in the money options is a mix of extrinsic value and intrinsic value. So you can see these two columns down here, there's a mix of both of them. So I want you to just imagine right now we are short the 75 strike. So we want to know exactly how much extrinsic value it actually decays if the market was to move in the day itself, right? Let's say if the move number of points in one day, how much extrinsic value does it decay in one day? So the way to do that, let's just do a simulation that we will be selling the 75 strike, right? Right now it's 79.62, and let's just assume that today itself, after we have sold, the market has moved up $5, all right, 5 points to 84.62. So that means your out of the money option would have become even more out of the money because now the market has moved up, right? So what happens to this extrinsic value? So this extrinsic value will basically decay to $1.85. So it decayed from, so it reduced the value from $2.19 all the way to $1.08 in just one day, right? On this day itself, you can see this is the value. That means your delta gone from 30 to 17 deltas. So that is about $1.11, $1.11, right? So here's the thing, right? If you sell out the money, put option 75 on the day itself, it made a big move. You only made $1.11, right? It moved 5 points, you made $1.11. Now, what if we compare this to an in the money put option? So let's say now instead we sold the 84 strike. So the 84 strike consists of both intrinsic and extrinsic value. So let's just calculate the total value that we will get by selling this option. So you take 4.38 intrinsic value and then you add 2.12. Okay, so you make, you sold this for $6.50. So same thing again. Let's say today, on the same day itself, it moved 5 points, right? So if it moved 5 points, so same thing, your in the money put option will now become at the money or become out of the money, right? So what happens to the intrinsic and extrinsic value? So if you were to see the intrinsic value, we immediately made this amount, became zero, right? We made $4.38, which is $438. But if you will take a look at the extrinsic value, it actually didn't decay. It actually increased. Remember, because this is the bell curve. So the in the money put option will immediately make this intrinsic value, but your extrinsic value will gain a little bit, right? But from here on, it will start to decay. So how much did you make on this $5 move up, right? If you move $5 up, the amount which you made, which we calculated earlier, was 4.38 plus 2.12, right? You get 6.5, and you minus off the extrinsic value. You minus off 3.575, and that means you made $2.92. You made $2.92 here, but with the out of the put money, you only made $1.11. So which means to say your in the money put option will make more when the market really moves quickly compared to the out of the money option. So the time when you want to make an in the money option, you want to sell an in the money put option, is when you feel there's going to be a big move, because you're going to make more by selling in the money put option as compared to selling an out of the money put option. Okay, so by the way, if you've enjoyed this video so far, I appreciate it if you just hit the subscribe button and give a thumbs up so I can create more videos like this for you in the future. Alright, back to the video. Okay, so let's take a look at the profit and loss graph for each of the put options. So we will see that there is some trade-off between them. So this is the out of the money put option. You can see this is the 72 strikes, and we'll be receiving $1.45 for it. So the trade-off is that for the out of money put option, there is a higher win rate, and with the higher win rate, it means it's much more forgiving, right? You could be wrong on the direction, and then you still could make money at the end. And this is what it means. You see, this is the percentage chance that you will make money on this put option, right? So 21.7% is if the market goes below the break-even price, you will lose money. So you have 21.7% chance of it dropping below your break-even to lose money, and you have a 78% 0.3% chance of making money. So that is why it's much more forgiving if you sell the out of the money put option. Anywhere the market could go, this is where the current market price is. If the market was to go down but it doesn't go below your break-even price, you would still make your money at expiration. And if it goes up, the problem is that you will have a lower profit and a lower ROI compared to in the money, because you only can make the maximum of your credit receive. So in this case, if you really remember, when we're selling out the money put option, we only get extrinsic value. So we do not get any intrinsic value. That means we do not get any capital gains on the stock movement. So what is the ROI which we can get for selling this put option? So the ROI is simply calculated by the premium, $1.45, and you divide it off by the strike, which is 72, and you divide it by the number of days to expiration. So in this case, this option is 40 days, and then you times 365 days. So that is a return of roughly 18.37%, which is not too bad. But if you were to compare this with the in the money put option, all right, let's just go to the in the money put option P&L graph here. We would see that we would have a higher premium received. And let's just calculate the ROI very quickly. So the ROI for this would be $5.77. We divide this by the strike price, 83, and then we divide by 40 as well, and then we times 365, and that would give us a ROI of 63.43%. So that is more than 3 times the profit you would make. Now, although you'll be making much more, all right, you have a higher profit and a higher return, the trade-off is that you actually have a lower win rate. So if you were to take a look at the percentage of these 2 points down here, right? So this is where your break-even price is. Again, you take the $5.77 minus off the strike price. That is your break-even price. So anywhere below this break-even price, you are losing money on your short put. Anywhere above this, you make money. So as you can see, the chances of you losing that money, all right, from here on is 44.47, which is much higher than the 20-something% for the out of the money put option. So what this means is that if you want to sell an in the money put option, you have to be pretty accurate on the direction of the trade, which means you do want the market to go up once you sell the in the money put option. So the question now becomes, which is better? Is out the money better or in the money better? And the answer is that it depends on what the stock actually does after that, right? Because if the moment you sell the out of the money put option, okay, and the market all of a sudden just rallies the moment you sell the out of the money put option, well, then you would have made more money with the in the money put option. Okay, so but on the other hand, if you sold an in the money put option and then the market started to tank, you would have regretted selling in the money put option. You wish that probably you have sold out the money put option, because it will give you a better chance of it winning. Because if the market was to go down from the point you sold it, it may not have gone past your strike price. And if it does go past your strike price, you still can actually roll it down to a further strike price. Okay, so it all comes down to your direction of the stock after you have placed the trade. Okay, so I want you to take a look at this chart right here. So basically, you see that the market is going down, and then let's say if you were to sell a put option, where would you sell? Right? Would you sell in the money or would you sell out of the money? Okay, so if you have seen my previous video where I said I sold in the money put, you will notice, you will realize that I actually sold at $300. Alright, so most people, if they were to take a look at this, the natural reaction would be to sell at 270 strike price, maybe even $260 strike price, and there's definitely nothing wrong with that. Alright guys, there's nothing wrong with selling further out of the money. The reason why I decided to sell 300, the strike price, was because I expected a bounce pretty quickly, and that is because I took a look at a few technicals and indicators for me to decide on this point. In the video, I mentioned that I saw this, right? So this made a lower low, all right? At the same time, the indicator, the stochastic, actually made a higher low. You see, higher low, lower low, okay? At the same time, what I saw was that there was a support here, all right? This was the previous low, and the market tried to break below this low, but it couldn't. And then it went back up and closed above here and forming this candlestick, which is a bullish pin bar. So with this bullish pin bar, coupled with the bullish divergence on the stochastics, I decided to take a short put at this strike price and in the money put because I expected this to go up. Now, I had at the point of time also considered selling the other put options, right, at 260. But when I take a look at the premium, this 260 was at the time, if I'm not wrong, was roughly around $5. All right, $5, and the in the money put at 300 was going for $20. So in terms of money received, this is $2,000, this is $500. So I thought to myself, say that, you know, I could definitely just sell this and then collect this $5 once it expires. But then what if the market really shot up immediately? You see, if the market really shoot up immediately, which I thought it would, right, then selling this $5 would be kind of a little bit of a waste, because I would not be able to pocket this nice move, right? If it moved up here, I'll probably, you know, choose to take profit at 50%. That means I'll probably only make $2.50, which is $250 when the market made such a big move. So I decided that, hey, I think I want to take on some intrinsic value and some extrinsic value as well. So that is how I came up with the strike price of 300, because there was a good mix of $10 in extrinsic value and $10 in intrinsic value, right? $10 in intrinsic value. So this extrinsic value and this intrinsic value. So I thought to myself, the mindset which I had at that point of time is that $10 is actually not a very big move to make, right? At the point of time when I short the put, the market was at 290. At 290, I thought to myself that you see the market, right? The range of each of the candles can easily go to about $10, and this is on a daily chart. That means each day it could make, you know, as big as a $10 move. So on the average, it could be around $5 move, $5 to $7. So I told myself that if the market is really going to bounce, it's probably going to bounce in the next few days. So if it's going to bounce in the next few days, $300 is definitely not a very difficult target to achieve. So I wanted to get this full $10 in terms of intrinsic value, and I decided on extrinsic value of $10 as well, because I thought that maybe, you know, there could be a chance that I'm wrong. Let's say if I'm wrong, but I was still confident it will get up to $300, it could take time, right? So maybe it could do this for some time before finally going back up to 300. So when it does this, it takes a longer time. It actually means I make more from the $20, because I would make the full intrinsic value of the $10, and the extrinsic value would have decayed much more than it would if it had just gone up on, you know, the next day itself, went up $10, right? So because of this thought which I have, I decided to take, you know, a 50-50% chance, a 50-50% split in terms of extrinsic value and intrinsic value. So the delta at the point of time, if I'm not wrong, was around 60 deltas to 65 deltas. That would give me a nice mix of $10 extrinsic and $10 intrinsic. So that is why I decided to take the trade. So true enough, the next few days you can see the market shot up. So my goal has been pretty much accomplished. It has already went above the 300 strike price, which means to say I took the full value of the $10 in terms of the intrinsic value, and then I took some of extrinsic value as well, because this whole trade took 9 days, right? So the whole profit which I took was about over $1,100 plus. Okay, had I sold this 260, the chances are that my 500 would only go to $250, which is significantly lesser than this. Okay, now what if I actually was wrong, right? I mentioned this in the other video as well. So if you want to sell an in the money put, the thing that you need to be comfortable with is being assigned on the put, and that means that if I sold at the 300 strike price, I have to feel comfortable buying 100 shares at 300. So for me, I was very comfortable doing it, because firstly also this is the QQQs, which is the index right? It means that in the long term, the market is going to go back up, regardless how long it's going to take. The next, half a year, the next 5 years, it will eventually go up. And I have the cash, right? I have the cash to fulfill 100 shares. So for me, it wasn't an issue for me to hold on to this in case I was wrong as well. So this is something that you want to take into consideration as well. Okay, so as you can see, the market in the end just went back down, and this was a good decision to exit because it was overbought. So if I already had the in the money put option, right, is at 300, and I see that it is overbought, it doesn't make sense for me to hold it, right? Because there's a chance that the market is going to go back down. If it goes back down, why do I want to give up the intrinsic value that I've already made? I've already made $10 in intrinsic value, right? This doesn't decay with time. It's just basically the difference between the strike price and the current market price. If I had a $5, if I sold the $5, 260 strike price down here, I could probably still say, I might want to hold, right? Because time, as it goes by, it will decay this money. You see, it will decay this premium. So over time, when it finally go back up, I will make money on this as well. So if I was holding it out the money put option, I could consider actually still holding on to this put to realize the full value if I wanted to, or if I wanted to actually try and get filled on this strike price. I wanted the market to go down, to go to 260, I could do that. Okay, so here's the time when you would want to sell an out of the money put. All right, the sell out of the money put would be if the current price is still far from where you want to go long. So let's say, for example, right now it's at 289, and then your ideal price that you might be saying to yourself that you want to get into this market will be $260, right? So $260 is still quite far away. So what I would do is I will take a look at the option chain, and I will see if it gives me a decent ROI. If it gives me a decent ROI, I'm definitely just going to sell the put, right? Because I've already decided I'm going to get long at 260 if the market was to go down and get me a sign, right? And finally, you want to sell the out of the money put is when you want to prioritize income, because out of the money put you can sell many more times than in the money put, because in the money put you have to be a little bit more using technicals, where you have to see where the market is, and then look at certain indicators to have the hypothesis or the assumption that the market is going to go back up, right? But if you're going to do the out of the money, it's going to be quite forgiving. The market could just doing those sideways until here, and then it expires. Then you can sell again another put option at this point, right? You can sell another 260 put option here, and if it goes sideways again, go back up, haven't filled again, then at this point of time when it expire, you can choose again to sell another put option, right? So this is very much for income, but you don't want to do that for in the money put. Okay, so in the money put is much more if you have the technical skills or technical analysis ability to see if you feel the market is going to have a rebound back up. So the time to sell in the money put is when you want to capture both intrinsic value and extrinsic value. So again, if that based on what you see on the chart, that the market is going to start to go back up, maybe you see a higher high, higher low, higher high, higher lows, then you might want to sell an in the money put above to try and capture the intrinsic value, because remember, intrinsic value can be captured immediately, right? So if on the day itself it moves up like say 10 points, you could just close that out and realize quite a bit of that. You can realize the full intrinsic value. And number two, you don't mind getting assigned at the strike price. Again, same thing, you want to make sure that you have enough cash to get assigned. If you don't have the cash, first of all, you shouldn't be in the money put in the first place. But if you are more experienced, then you need to know where to cut loss. That means you need to know based on the chart, on the graph. Let's say if you were to go back to the P&L graph, you could see that, oh, let's say I only want to lose $1,000. Maximum loss is $1,000 on this trade. Then I'll be taking a look at the point where I will lose $1,000, which is at this point down here, right? So it's telling me that if the market reaches around in between 65 to 70, maybe around $67, if the market goes down to $67, I am going to cut my loss immediately, right? I'm not going to hold on to this trade and see what happens. So this is if you do not plan to get assigned on the shares. Okay, so finally, in the money puts, most of the time, or rather all of the time, I would suggest that you would take a look at this indicator to see whether is it overbought or is it oversold, right? Because the last thing that you want is to sell in the money when the market is overbought, right? If the market is overbought, it means to tell you that there's a higher chance, higher probability that the market is going to go down than it is going to go up. Now, of course, this can, it's not always 100% accurate, right? The market can still keep going up for sure, but you definitely still do not want to fight against the movement of the market, because, right, if you know the market has a higher chance of it going down, you don't want to sell something of in the money and then after that you get stuck with the position when the market goes down. So you'll be smarter to wait till the market is oversold, then you sell in the money put option. So maybe at this point when you see that it is oversold, you could sell the 280 in the money put, or maybe even the 290 in the money put. So this will give you a much higher chance of success on your in the money put option. So in general, if you're still new to options trading, all right, and you have just gotten started selling put options, I would suggest that you start off with out of the money put option first, mainly because it is much more forgiving. All right, it's much more forgiving. Only once you become more advanced and you're comfortable with the fact that you can get assigned on the shares and you want to make intrinsic value on the move up as well as extrinsic value, then you can start to consider exploring in the money put options. Alright guys, that's it for this video. I hope you liked it, and if you have, please subscribe and please hit the notification bell so you'll be informed whenever I release a new video like this. And as always, thank you for watching. I appreciate your time and I'll see you in the next video.